Wondering how tariffs are affecting your retirement plan? You're not alone. Today, we'll explore strategies to help you to thrive, not just survive in this changing economic landscape. We'll examine today's economic realities and discuss their impact on your retirement savings. I'm Van Richards, a chartered financial consultant, and I appreciate you joining me. Please stay tuned until the end for an important notice about the limitations of this information. When we turn on the news, we are bombarded with headlines. The media sensationalizes everything about inflation, interest rates, market volatility, tariffs, and economic uncertainty. This makes it nearly impossible to determine what actually matters to you, and it's overwhelming. Today, we'll cut through that noise to help you to find clarity and to make smarter decisions about your retirement savings. You might be wondering to yourself, should I be making changes to my investments? Is my current strategy still appropriate? How will these economic changes affect my retirement? Now, these are all excellent questions, and it's exactly why I created this presentation. In the next few minutes, I'll focus on what truly matters for your long-term financial security. Let's start by discussing how to build your retirement on solid ground. First, recognize that your retirement journey spans decades, not days, weeks, or months. Today's news is deliberately sensationalized to capture your attention for today. But that short-term focus conflicts a lot with your long-term needs. Your strategy must withstand decades of economic cycles. Understanding these broader patterns really helps you to avoid knee-jerk reactions that could derail your financial goals. Second, different economic conditions create different opportunities. What works in one environment might falter in another. Today's insights will help you to position your portfolio effectively for both present and for future. And finally, confidence comes from understanding. When you grasp how economic forces affect your investments, you're a lot less likely to make emotional decisions during market turbulence like what we're seeing right now. Let's clarify what this presentation is not. This is not about predicting the future or about timing the markets. Strategies like that consistently fail even with professional investors. Instead, what we're doing is we're building an informed foundation for long-term success. Now, before examining the current economic landscape, however, remember that today's session is educational. It's not specific investment recommendations. However, the principles that I'm going to talk about will help you to make more informed decisions about your personal retirement strategy. So what's driving this chaos? A lot of people are going to blame tariffs. And yes, tariffs are a contributing factor, but they're not the only factor that's sending the markets into turmoil. You see, consumer spending has a big impact on it too. Consumer spending has been consistent over past months, but it could slow down more if tariff-driven prices go up. Now, importantly, spending has shifted from goods more to experiences, and this trend could stall if costs increase. It's also important to recognize how businesses are investing in their own growth. Businesses are investing in technology and efficiency, but they remain concerned about the supply chain and the disruptions that may happen in the event that tariffs do go up. And they're also concerned about the higher costs, particularly industries like automotive and construction, who are still really battling delays that originated back during COVID. So how will tariffs affect you? Tariffs are going to ripple through the economy and it's going to impact markets, inflation, and supply chains. But you have to ask yourself this particular question. How does this influence your 401k? The answer to that is going to be this. That depends upon your portfolio composition, which we're going to explore shortly. Now, two groups need special attention. First, if you're within 5 years of retirement, volatility amplifies sequence of return risk. Early losses as you begin withdrawals hurts more than later ones. Don't lock in all of your assets and research sequence of return risk very, very carefully. Second, if your holdings are down, ask yourself this, is selling now fear-driven or does it serve a long-term strategy? Let's provide some perspective here. Yes, the markets are in turmoil, but really, isn't it always? It's the nature of investing. If you don't like that, you need to find other avenues to deal with your money. That's just kind of the way that it is. Today, tariffs are impacting manufacturing and retail and fueling the volatility. Tomorrow, it's going to be something else. We want to deal with this today. If your portfolio is concentrated in manufacturing and retail, you're probably feeling this more acutely. With diversification, however, across technology and healthcare or domestic focused firms, you have some buffers, though no one is going to be absolutely immune. Now, bonds tell another story. As investors seek safety, bond prices are going to rise, but tariffs drive inflation, and inflation, if it goes up, interest rates could increase, and that's going to push bond values down. Now, that said, the Federal Reserve has signaled the potential for rate cuts. Some economists are actually predicting 5 or more before the end of 2025. Now, for savers and retirees, remember this. Don't panic, but don't sleepwalk either. Recent volatility could be your cue to review your allocations. Are you positioned to weather this particular storm? If tariffs escalate, consider shifting toward resilient sectors like utilities or consumer staples. Avoid hasty reactions. Retirement's a long game and markets typically react before finally settling down. Let's get specific about how the current economy and tariffs may affect major stock sectors like defensive stocks and sensitive stocks and cyclical stocks. We want to begin with defensive stocks like consumer staples, healthcare, and utilities, how they may actually see reduced profits from higher cost. But remember this, stable demand for essentials like this provides some resilience for these particular sectors. Then we move on and look at the sensitive sector stocks. These are technology, industrials, energy, and communication services. They present mixed outcomes. Tariff impacts are largely dependent upon the company's reliance on imports versus domestic production, and the results will vary significantly depending upon the particular sector and the individual company too. The sector that I think that you need to be most aware of is going to be cyclical stocks. You see, cyclical stocks face the greatest challenges. Consumer discretionaries like cars and retail, basic materials like steel, chemicals, financial services, and real estate. Their sensitivity to consumer spending and economic conditions makes them more vulnerable to tariff pressures. For strategies that'll help you to better manage sector trends, I want to suggest that you explore a course that I've created that's called Plan, Pick, and Profit. You'll find more about that at planpickprofit.com. Now, if you take one thing away from this video today, I hope that it's this. You see, the stock market, it can be like a casino in the short run. It's more like a game in the medium run, and it's a wealth creation device in the long run. The key is long-term focus. Remember that markets typically react before economic changes materialize. And that's why the markets have been so chaotic recently. They can't figure out what's going on to happen next with tariffs. But be calm. Things will work themselves out. And lastly, ensure that your retirement plan aligns with your personal financial goals and your particular risk tolerances. Now, in my next video, we'll explore how current economic events may impact investment categories that we've touched on just a little bit. If you found this information helpful, hit the subscribe button and follow me to get notified when the next video is actually released. Remember this though, this information is educational only. It's not investment advice. Please stay tuned for more details on limitations of this information next.